Okay. So again, those of you in Zoom land, if you have questions, you guys can put those in chat. Or there's people here, if they have questions, we'll address those as well. So let's start by let's draw aggregate demand and aggregate supply with a inflationary gap to start with. So again, we're going to draw aggregate demand, aggregate supply with a inflationary gap. And as you draw yours, check your labeling. You know, if you have to cheat and look at mine because you don't remember like what a y-axis is or an x-axis for something or whatever, that might be a good thing to kind of review, practice drawing that graph so that you have it down solid. That's as much as I can zoom in right there. So we've got our inflationary gap. So next, what I would want you to do is identify a fiscal policy that could be used to close this gap. So identify a fiscal policy that could close this gap. All right, so for our fiscal policies that would close an inflationary gap, you could put increase in taxes or decrease in government spending. Either one of those would close an inflationary gap. What I want you to do next is tell me which would have to be large. Like if we wanted to close the gap, would it take a larger increase in taxes or a larger decrease in spending to close that gap? So again, if we want to close that gap, would the tax increase have to be larger or would the spending cut have to be larger? This is why we're doing this, right? Yeah, this is definitely. So if you had a question that asked something like this, right? Would it have to be the tax cut, the tax increase or the spending cut that would have to be larger? And you probably have to explain it. The answer would be that the tax increase would have to be larger than a cut in spending. And the reason why is basically because of savings, because some of the tax would come from savings. The truth is usually you see this question with a recessionary gap more than an inflationary gap. So usually with like a recessionary gap, the question would be, would it take, like, what would have to be larger, a tax cut or the spending increase to close the gap? And usually the answer would be that the tax cut would have to be bigger And the reason why is because some of it would be saved. So it's more common to see this question with the recession, but I just wanted to remind us of that, even though we still have an inflationary gap here. So really comment on like AP Econ questions would be like, first, like identify a recession, a fiscal way to solve this problem. And then like a follow-up question would be something like, assume instead that the Fed decided to use monetary policy to solve this problem. So I don't know, what open market operation could be used to close this gap and then show it on a correctly labeled graph of the money market. So we still have our inflationary gap here. What open market operation could be used by the Fed to close that gap and then show it on the money market? All right, so a couple things that we're reviewing here with this one. One was we're reviewing that phrase open market operations, and that has to mean buying or selling bonds. So remember, the Fed buys big, the Fed sells small. If the Fed buys bonds, it makes the money supply bigger. If the Fed sells bonds, it makes the money supply smaller. So we have inflation going on. The Fed is going to sell small, and so that's going to make our money supply shrink to the left, which causes our nominal interest rate to go up.
You said open market was the sell bonds or buy bonds?
So open market operations means buying or selling bonds. And when you have an inflationary gap, that means that you have to sell bonds to make the money supply smaller, right? And then very likely what you would see is a follow-up question like on an FRQ that would say like, okay, now go back to your original graph and show the effect of this, right? And explain, probably. So go back to that original graph and explain. So when we go to show the effect, of the Fed policy, when they cause the nominal interest rate to go up, we show that by decreasing aggregate demand to the left, and that closes our gap. And our explanation is that aggregate demand decreased because investment would go down due to higher nominal interest rates. You could also say that consumption would go down, but it's probably a safer bet to stick with investment on this one. All right, so I'm going to erase this. We'll do another question with you. So on that one question right there, we reviewed the aggregate demand, aggregate supply model, inflationary gaps, fiscal policy, monetary policy, the money market. Yeah, so we covered a lot of things on it, just one question, right? All right, so let's do another question. Let's look at all right. So let's draw the aggregate demand, aggregate supply model one more time. And let's do it with a recessionary gap this time. We'll start with a recessionary gap. So for the next follow-up question, right, we've got our recessionary gap. I'm telling you to assume that the current output is 90 billion. My full employment output is 140 billion. And my MPC equals 0.9. So my MPC is 0.9. I want to know how much should the government spend to close that gap? So we started off with a recessionary gap, and then now we're looking at fiscal policy. If this is my current output, 90 billion, my full employment is 140, my MPC is 0.9, how much should the government spend to close that gap? So take a moment, work on that. They are not, the only equations that you need to know are like the money multiplier and the spending multiplier, and they're not going to be on the test. And like, honestly, the reason why they're not on the test is because like with the money multiplier, it's like, whether the question is about like how much like total loans would come from this or like total money, like it's slightly different variations. And I feel like giving the equations would actually like either I'd have to give you a huge long list, or it might not, like if I didn't give you every variation, the question might not match up perfectly and it might actually make it harder rather than, that's why. Okay. So for this one here, we have a gap of 50 billion So I'm gonna say 50 billion equals 1 over my MPS, which is 0.10. My MPC is 0.9, then my MPS is 0.1 times the amount of government spending that would be needed to close that gap. So our answer to this one here is $5 billion. That if the government spends 5 billion, that would shift aggregate demand by 50 billion, which would close our gap on our graph.
What are you doing to get to 50 equals 10? You're dividing by 10?
So what I did was, the first thing is I had like the difference between here and here is my gap. So this was 90, this was 140. So that's where the 50 comes from, is there. And then the 0.10 is from MPS. So remember, MPS plus MPC equals 1. So if my MPC is 0.9, then my MPS is going to be 0.1, and that's where that comes from.
So like how do you get from there to the 50 equals 10x?
1 over 0.10 is 10.
Oh, so you're just dividing that out.
Yeah, I just divided this into that, and that's where you get the 10x. And then I divided both sides by a 10. Yes?
Can we use notes on this test since there's 3 chapters?
No, but thank you for
Thank you for
asking. So there, oh yeah, so I think I answered that, but the $50 billion that came from the full employment where we want to be minus where we were, the 90. So 140 minus 90 is where the $50 billion gap came from. So follow-up question. Assuming that the US government had to borrow most of the money that it used to increase its government spending, if the US government went more deeply into debt, I want you to draw a graph of loanable funds and show me what happens when the government goes into debt to pay for the higher spending. So our follow-up is we're drawing loanable funds and we're showing what happens when the government goes into debt. So you could have done one of two things on here. You either could have increased demand or decreased supply. Either one is an acceptable shift on loanable funds to show the impact of government debt. That you could either look at it as the government is borrowing so that they're increasing the demand for loans, or you could look at it as people are taking their money out of savings to go buy bonds, and that would decrease the supply of loans. So either way, decreased supply, increased demand, either way, it's okay. It shows real interest rate increasing, right? Follow-up question. If the real interest rate increases, what is the effect on aggregate demand? This is similar to the last question I asked you guys. When we have an increase in interest rates, that causes people to borrow less, which means less aggregate demand. So if we wanted to go back to our original graph, right? On this original graph, if they wanted us to show the government spending and the debt, if they wanted us to show both of those on this original graph, it would look like this. First, aggregate demand increases because of the increased government debt, closing the gap. But then when I should say because of the increased spending, closing the gap, aggregate demand increases to the right, that closes our gap. But then because of the increased debt, aggregate demand is going to go down a little. We could bring aggregate demand back something like this. It wouldn't go all the way back. What would happen is we get like a little rebound. I'm not going to ask you to do that, but it does occasionally pop up on like AP tests. But more what I wanted to emphasize, what I really wanted to review with you guys is that interest rates affect investment, which is part of aggregate demand. So whether it's the loanable funds graph or the money market graph, if interest rates go up, aggregate demand goes down as a result. Right? So it's really important that you understand this relationship between interest rates and aggregate demand. Any questions on this guy? So on this question here, we reviewed aggregate demand, aggregate supply. We reviewed recessionary gaps. We looked at the spending multiplier. And this, what we saw right here, where the increased government debt caused the real interest rate to go up, that's called crowding out. So that was on like my list of terms to review for the test. What you're looking at right here is crowding out. Increased debt causing the real interest rate to go up, which causes aggregate demand to go down a little bit. So like on this graph right here, this like bounce back, that's what the crowding out is where it's like aggregate demand goes up, but then it bounces back a little bit because of some crowding out. That's how you show that on the graph. All right. Let's take a break from aggregate demand, aggregate supply for a little bit, and then let's look at something else. How about for our next question, why don't we look at let's do another graph of loanable funds. And this time we'll do the graph of draw the graph of loans in the United States, and we'll ask what would happen if, say, I don't know, Mexico had significantly lower real interest rate. So we're going to look at the graph of loanable funds for the United States, and then what would happen if Mexico had a significantly lower real interest rate.
Is this test still 40%?
The test category is 40%, but the two tests are averaged together and they're weighted the same. So this test is like 20% of your grade, but the reality is is that unless you do significantly better or worse, it's not going to move your grade a whole lot. Don't panic. You're going to be okay. I promise.
Too late.
I can see it in your eyes. You're going to be okay. Just breathe.
What topic is this?
This is going to go over, we're going to do this right here. That's just capital flow. And then we're going to hit Forex on this one as well. So again, we've got US loanable funds. Real interest rates are significantly lower in Mexico. So what that's going to do is that's going to cause Mexican nationals to take their money out of Mexican banks and want to put it into American banks. So what's going to happen for loans in the United States is that we're going to see there's going to be more money available. So the supply of loans increases. Which causes my real interest rate to fall. Remember that the savings is the supply of loans, and savings is always going to chase higher interest rates. So if they're lower in Mexico, it's going to increase. Could you shift demand instead? Yeah, that's a good question. Could you shift demand instead? I would say I would advise not to shift demand in this instance. If like maybe in theory, like Americans might be like, I'm going to go get loans in Mexico instead of getting loans in the United States. So the demand for loans in the US goes down and demand for loans in Mexico goes up. But that's really not done with much regularity. I would say the like wealthy people shifting their money to take advantage of higher savings in other parts of the world is much more likely to happen than demand shifting and people trying to get, loans for a mortgage or a business or a car in a different country for where they're going to be buying the house and things like that. So I would probably not shift demand on this one. So we have a decrease in our real interest rate. As a follow-up question, drawing a correctly labeled graph for the US dollar in the foreign exchange market, show the effect of the lower I guess this capital flow, show the effect of capital flow on the value of the US dollar. So compared to the Mexican peso. So I'll restate that because it was kind of rambly.
Please.
Draw a correctly labeled graph of the value of the US dollar in the foreign exchange market compared to the peso. And then show the effect of the lower real interest rate in Mexico, show what that does to the value of the US dollar. So we're going to draw the Forex graph for the United States. Now, if we want to, there's nothing that says we can't put the graph for Mexico right next to it if you want. So there's a question in the chat that says, could I briefly state what capital flow is again? Capital flow is when you have different real interest rates in different countries, that people in the country with the lower real interest rate, they're going to take money out of their banks. So capital is going to flow out of the country with the lower real interest rate. And they're going to put that money in banks of the country with a higher real interest rate. So capital will flow in to the countries with the higher real interest rate. And that whole process is called capital flow. So now we want to show the effect of this on the value of the US dollar. So I put my US dollar graph right next to my Mexico graph because it helps make a lot more sense what's going on here. So the first thing that's happening is people in Mexico are taking their money out of Mexican banks and they're going to trade it to get US dollars to put into American banks. So right now in my head, I'm picturing that bucket. You guys remember the bucket with the foreign exchange? I'm picturing my bucket and I'm picturing somebody with a handful of pesos putting it into the bucket. So the supply of pesos goes up. And when the supply of pesos goes up, the reason why is because they want to get those US dollars so that they can save them in a US bank. And so the demand for US dollars goes up. So the US dollar appreciates or goes up in value as a result of that capital flow that we saw here on this graph. So one of the things that I want to review with you is just because you see something talking about like real interest rates and a different real interest rate in different countries, that doesn't mean that you're automatically going to be drawing loanable funds or you're automatically going to be drawing the FOREX graph. That you have to read the question and you have to figure out, is the question saying like, are they asking about loanable funds or are they asking about the value of the US dollar in foreign exchange? If it's foreign exchange, then you're drawing this right here. If they're asking you about loanable funds, then you're drawing this one right over here. Now they're really similar. It's just really a different y-axis, but you got to make sure you got that right. Let me see. Yeah, so there's a question in the chat, and basically it asked about an example of foreign exchange. Anytime people are changing their currency from one currency to another, that's foreign exchange. All right, let's look at another question, unless there's any more questions on this. All right, I'm not going to put it on my test, but any of you guys that are taking the AP test, there is a follow-up question that comes from this. So if you take the AP test, sometimes once you figure out what's happening to a currency, there is like an additional, like, if your currency appreciates, that means it's getting harder, it's more valuable, it's harder for other people to get. One of the things that we're going to see is it's going to be harder for the United States to export in this situation right here. Because their currency is getting more valuable, other people can't afford it, so it's going to be harder to sell American stuff. So when your currency appreciates, it's not always a good thing. It makes it harder for you to export, and it makes other countries' stuff cheaper. So like, if you wanted to go on vacation to another country, this is really good for you. When your currency appreciates, everything else in the world seems cheaper. So it's like your money goes further when you go on vacation. The downside is it's a lot harder to export stuff, which is part of why, like in today's class, where we learned about how the United States has a big trade deficit, one of the main reasons why the United States has a big trade deficit is because our currency has been really stable for the last 50 years. And because our currency has been so stable, it's gone up in value. And when it goes up in value, it's harder to export. So again, I'm not going to put that on this test, but if you're taking the AP test, I wanted you to be aware. So, all right, let's look at another question. Let's see, where should we go next? Let's stick to this. All right. Okay. Next, what I want you to do is I want you to draw a graph of aggregate demand and aggregate supply at full employment. And I want you to draw a side-by-side graph of the Phillips curve that goes with it. There was a question in the chat about appreciate and depreciate. Appreciate means the value of money goes up, not the amount. It means the value of money goes up, and depreciation means the value of it goes down. All right, so side by side, aggregate demand, aggregate supply, Phillips curve at full employment. All right, so remember when you're doing the Phillips curve and you want to do the side-by-side graphs, remember to start it like this, draw the two, start it like that. And then you want to connect them together. Wherever the intersection is on this graph, wherever the short run equilibrium is on this graph, that's going to line up with the current equilibrium on that graph. And then we put our long run curves in there so that if we had like we want to start off with a recession, we would go like this, and then we just mirror it over there. So that we want to do a recession, we could do it that way. We want to do an inflationary gap, they'd be on the other sides. So if we're doing our side-by-side graphs, that's how we start off. All right. Next, what I want you to do is I want you to draw me a graph of the money market and show me what would happen if the Federal Reserve decided to lower the discount rate. So draw a graph of the money market and show me what would happen if the Federal Reserve decided to lower the discount rate. And then after you've done that, after you've drawn your money market and showed what happened when the Fed decreased the discount. I said decrease the discount rate, right? Yeah, okay. After you've done that, I want you to go back to your original two graphs and show me on both aggregate demand and aggregate supply and the long and short run Phillips curve, show me the effect of that Fed policy on both of those two graphs. So I've increased aggregate demand because my nominal interest rate went down. And as we said before, when nominal interest rates go down, investment goes up. When investment goes up, aggregate demand goes up. So I increased aggregate demand on this graph. What happens on this graph? Aggregate demand went up. When aggregate demand goes up, this is the mirror. So what's going to happen is my point is going to move right there. Because these guys have to line up still.
Wait, is that not an increase?
What was that?
Is that not an increase? 0.8 of 0.8?
It is an increase in price level, but it's a decrease in unemployment. So this right here is the same thing as this right here. It's just mirrored. So it's very possible when you said increase aggregate demand that what you really meant was the point moves.
Yes.
And I just wanted to clarify your language, but I think you were on the right track. So on this one, once again, we reviewed how a change in interest rates affects aggregate demand. Super important concept in economics. So change in interest rates leads to a change in aggregate demand. And then what we also reviewed on here is that when aggregate demand shifts, it leads to a move on my short run Phillips curve. And if we put the graphs side by side, that tells us where it's going to move to. All right. So we review this and this. All right. Next one. Let's do this. Actually. All right, so I've got a balance sheet for you here. For those of you at home, if you're having trouble kind of reading this, I've got $500 of demand deposits on this side. I've got $50 of required reserves, 150 of excess reserves, 200 of loans, and $100 bond on this side over here, assets for this bank. And now I'm going to give you guys a series of questions. Let's see. Actually, maybe I'll put my questions off to the side over here. Leave that right there. All right. So number one. What is the reserve ratio? So that's number one. What is the reserve ratio? Number two. What is the largest loan this bank can make? So that's number 2. Number 3. No, I don't want to ask that. Ask. So number 3, if the Fed buys the $100 bond, what is the largest possible change to the total money supply? All right, and then the last one, if a customer withdraws $100 from Tweet Bank, what happens to required and excess reserves? So, what is the reserve ratio? What is the largest loan this bank can make? If the Fed buys the $100 bond, what is the largest possible change to the total money supply? If a customer withdraws $100 from Tweet Bank, what happens to required and excess reserves? So I'll give you guys one more minute to work on those, and then we'll go over the answers together. I will say my expectation for you guys is that you should be able to get numbers 1, 2, and 3 right. Number 4 should be pretty hard for you, but that's kind of where I'm at right now. So let's see how you did. First, number 1, what is the reserve ratio? Well, our reserve ratio, we've had $500 deposited, 50 has been held in required reserves. So 50 is 10% of 500. So my reserve ratio is 10%. So the answer to number 1, 10%. You divide the RR divided by DD. So you get 50 over 500 is 1/10, which is converted as 10%. So you could put it as 0.10 would work as well. Number 2, what is the largest loan that this bank can make? So banks can only loan what? Excess reserves. So this bank right here can loan out $150 because that's what they have in excess reserves. The amount that's the $200 in loans, that's money that has already been loaned out. They can't loan it again. That's fraud. 3, if the Fed buys the $100 bond, what is the largest possible change to the total money supply? The change to the supply of money equals 1 over the reserve ratio times the amount of new money. Or when it's a bank making a loan, this would be the amount of the first loan. But in this case, when it's the Fed buying the bond from the bank, it's the amount of the bond that they're buying. So we get X equals 1 over 0.10 times 100. And our answer is $1,000 for number 3. No.
Is the RR for the stuff you just wrote down reserve ratio?
Yep, and that's this reserve ratio, the same one that we found in number 1. That's what we're plugging in right there.
And that's not, that equation isn't considered money multiplier or spending multiplier.
This is the money multiplier equation right here.
Okay, got it.
But again, the money multiplier equation is a little bit weird because it's like sometimes the question would be like, what's the total amount of loans that could be created? And so you use like the money multiplier for that one, and you plug in the first loan. Sometimes the question is like, how much money is created when the Fed does something? Sometimes the question might be like, how much money is created when a person puts money in the bank? And when the person puts money in the bank, you have to take out the required reserves, and then whatever's left over is what goes into the money multiplier. So like, for instance, like I almost asked this up here. I'll just do it, right? Just to show you guys. Question 5. Right? Someone, no, I haven't done question 4 yet. We'll do question 4, and then I'll come back and I'll add a question 5, and we'll look at a couple more here. Question 4, if a customer withdraws $100 from Tweet Bank, what happens to required and excess reserves? Let's do this. We'll do purple. We only have $400 in demand deposits left because they took 100 out. So where is that 100 going to come from over here? We can take it from excess reserves. Let's do that to start. All right. So we'll be like $50 of excess reserves. There's a problem though. If I have $400 of demand deposits, how much required reserve should I have? 40, because we use that same reserve ratio. So that means I should have 40 in required reserves. So what happens to that $10 that used to be required that's not required anymore? Where does it go? It goes to excess. So this is going to go to 40. And then this goes to 60. And then we just need to check, do our numbers all add up? 1, 2, 3, 400, 400. And is this 10% of that? The key here is when we have a withdrawal, we have to recalculate our required reserves. That's what I'm showing here. Now, I'm not going to test you guys on number 4, but the College Board does sometimes test that on their test. So it's a little bit harder of a question, like when you have those withdrawals and then you have to adjust the required reserves. That's like an AP test question. So I'm not going to put that on my test. If you struggle with number 4, don't worry about it. But if you're taking the AP test, that number 4 is a question that is one that they sometimes ask. Something, number 5, something that I'd be more likely to put on my test. Timmy deposits $200 into Tweet Bank. What is the effect on required and excess reserves? So Timmy deposits $200 into Tweet Bank. What is the effect on required and excess reserves? If we get a $200 deposit, we're going to have to add $20, 10% to required reserves, $180 to excess reserves. So some sort of answer that says excess reserves go up by 180, required reserves go up by 20 because of that deposit. Yeah.
The 400 direct deposit that you have right after, that was from question 4, right?
Yes. Yeah. That was from 4. Question 6. Based on the deposit in question 5, what's the total possible amount of loans that the banking system can create? So again, based on the deposit from number 5, what's the total possible amount of loans that the banking system can create? I'm not going to write that all out. I'm out of room. So again, what's the total amount of loans that can be created by the banking system based on the deposit in number 5? So what we're going to do for that question, we're going to use the money multiplier. X equals 1 over 0.10 times the amount of the first loan. From that $200 deposit, the biggest possible first loan could be 180. $1,800 is our answer. Any question on the bank balance sheet or the money multiplier? Like I said, if number 4 was hard for you, don't worry about it. That's harder than what I'm going to put on my test. But the other ones are good practice questions. All right, next, let's look at, let's see. Let's see, what should we practice next? Let's see. Using a graph of using a foreign exchange graph. I'll just tell you guys, I'm not gonna write this whole thing out. Assume that more Americans start buying a lot more wine from Italy. Show me what would happen to the value of the US dollar in the foreign exchange market. So again, assume that Americans start buying a whole lot more wine from Italy. In Italy, they use the euro. The symbol for the euro is a C with 2 lines through it. That didn't show up very well, did it? So using the foreign exchange graph for the US dollar, show the effect of Americans buying a significant amount more wine from Italy.
So we're looking at this for the US dollars or the US?
The US dollars is what we're looking at. So I drew my graph side by side. I got my US graph, I got my Italy graph there. You did not have to do the Italy graph if you don't want. Again, I like to put them side by side. It helps me, make the model a little bit more concrete for me. So what's happening here is I'm picturing a bunch of Americans. They've got fists full of US dollars because they want to buy that Italian wine. They're on their way to Italy to buy the wine. And they got to stop where? They got to stop in FOREX, the trading bucket, right? We're picturing the bucket right now. They're putting their fistful of US dollars in there. So what's happening to the value of the dollar? It's depreciating because the supply is going up.
I shifted demand to what?
Probably. It probably works as long as, as long as you get the right answer on this side right here, that's what really matters. But in this instance, I really feel like it would be it really should be the supply of US dollars increasing. So you got to the right place, but logically, if Americans are buying a lot more stuff from another country, I think you should think of them taking their US dollars and wanting to go buy the stuff, but they got to trade it in. So the supply of dollars goes up in the bucket. And then on the Italy side, if you want to make the supply of Italy go down, that's fine. If you want to make the demand for Italy go up, that one's fine. So US dollars depreciate and Italy euros are going to appreciate. Follow-up question. When the Americans buy this wine from Italy, is it a credit or a debit on the current or capital account for the United States? So, right, money's going out. So when we ask, is this a credit or debit on the current or capital account? It's going to be a debit for the United States. And it's going to be a debit on the, which account? The current account. Because they're buying goods and services. What about for Italy? What is this going to be?
Credit on current.
It's going to be a credit on the current account. Because the money's coming into Italy for goods and services. So, let's see. We just did this.
Wait, why is it on current?
Because the current account includes, what was that?
It's just a transfer, is that why?
No, it's on the current account because it's like a good or a service that's being bought.
Oh, right.
So-
I totally forgot this was about wine. I was just looking at the.
No worries, no worries. So, all right. Let's do another question. Let's start with aggregate demand, aggregate supply within, what was that? Yeah, of course.
Are we sending at 1 today?
1:30.
Oh,
But you can leave, I mean.
okay. Yeah, I'm sorry. I
You
gotta
can,
go.
yeah, no worries. You can leave whenever you want. No, you must stay. Sorry. The door's not locked. So for the next one, let's do aggregate supply, aggregate demand with a side-by-side Phillips curve, and let's start off in a recession. So this one's pretty tough. So we just have a side-by-side Phillips curve, and we're going to start off in a recession.
Did we review everything, or are we just going over stuff like a few times?
What was that?
Did we review everything already? We're just like
Yep.
reviewing stuff.
Yep. Right. So side by side, aggregate supply, aggregate demand, and Phillips curve. So side by side, we put them there. We draw that, line them up. And then to create a recessionary gap, that was terrible. That goes there, so then that one goes there. Alrighty, so my recessionary gap, you can see that my current output is below full employment. So we're in a recession, we're underproducing. Over here, you can see my current unemployment is higher than the natural rate. So we have higher unemployment because we're underproducing. Next, identify one fiscal policy that could be used to close that gap. So identify one fiscal policy that could be used to close that gap. All right, so we can increase government spending or we can lower taxes to close that gap. Next, identify what open market operation the Fed could use to close that gap. So what open market operation could the Fed use to close that gap? Instead of fiscal policy, if we decided to use monetary, what open market operation? Then buying bonds is correct. Next, let's see. Let's assume
So the open market operations, the only options are buying bonds or selling.
you got it. You got it. All right. Assume the Fed determines that the money supply needs to increase by $100 billion to shift interest rates enough to close the gap. If the reserve ratio is 25%, how much should they spend buying bonds? How much should the Fed spend buying bonds? If the reserve ratio is 25%, and if they want to increase the money supply by 100 billion. So our equation, we use the money multiplier. The supply of money, change in supply of money equals 1 over the reserve ratio times the amount of bonds being bought or sold. So we end up with the change in the money supply is the $100 billion. So we have that over here on the left side of the equation. We have 1 over the reserve ratio was 25%, so I put 0.25. And then the amount of bonds that they need to buy, that's the question. That's our unknown X. So 0.25 goes into 1. There's 4 quarters in a dollar. So 0.25 goes into 1 4 times. So we get 100 equals 4x. And then I divided both sides by 4. And when you divide both sides by 4, you get x equals 25. That's our answer. This is the money multiplier.
Can you show us what the spending multiplier equation is?
Uh-huh. We can definitely do that. Yes, please. I think that's yeah, we can use this same model, basically the same thing. We'll do let's see, number 1.
These are related to the same question.
Yeah, it's the same ideas, still a recession, same idea. Assume that the MPS is 0.2. All right. Assume that the MPS is 0.2 and the government increases spending by 50 billion. What is the total change to GDP? And then I'm going to put a follow-up question up here as well. And then my follow-up question is, if the government used the 50 billion for a tax decrease instead, would the effect on the economy be smaller, bigger, or the same? Explain. Alrighty, so assume that the MPS is 0.2 and the government increases spending by 50 billion. What is the total change to GDP? My change to GDP equals 1 over MPS times the change in spending. That's our spending multiplier equation. So I'm going to get X equals 1 over 0.20 times 50 billion. 0.2 goes into 1 5 times. We get 250 billion as our answer. Part 2, if the government used the 50 billion for a tax decrease instead, would the effect on the economy be smaller, bigger, or the same? Explain. The answer is that the effect on the economy would be smaller. And the reason why is because some of the money would be saved. That's the explanation that some of the money would be saved before it ever got spent. That's the explanation that we'd be looking for. Next question. Assuming that this was enough to close the gap, show it on both of these two graphs. So assuming that this government spending was enough to close the recession, show it on both of the two graphs. So to close that gap, aggregate demand shifted to the right because government spending is part of SIGIX, which is aggregate demand. So we increased our spending. So that shifted aggregate demand to the right. The same time that it shifted aggregate demand to the right, it made my point move up and to the left. So now we're back at full employment on both graphs. Yay. Everybody's happy. So I've got 4 minutes left. I do have to, at 1:30, I do have to be done because I have to be home by 2 for a Zoom meeting. Any final questions that you guys would like me to address? I feel like we went over that list pretty good.
Yeah.
Okay. Well, thank you guys for coming in person. I'm glad it wasn't me talking to just, no offense, but I'm glad it wasn't me just talking at a screen for an hour and a half. So you're welcome. And so I have a question. Let's see. Will we need to know the tax policy equation? Is crowding out important? If so, can we go over it more? Yeah, I'll go over crowding out. I'll do another quick question of those real quick. Megan, your question about the tax policy, the equation, I'm not going to put one of those questions on my test. If you're taking the AP test, then you do need to know the like how the equation changes for taxes. You just multiply it times MPC. But if you're not taking the AP test, or if you're just preparing for my test right now, don't worry about the tax equation. Bye, ladies. So, all right, crowding out question. Yeah, let's do a crowding out question real quick, and then I'll be done. So for crowding out, the first thing is that you don't need to You know, I'm not going to make you show on the graph. I'm not going to make you show the effect of crowding out. I just did that earlier for those of you taking the AP test so that you kind of you've been exposed to it. So if they ask you to do like, you know, if they ask you to show the effect of crowding out on a graph, you know, it just is basically a reduction of aggregate demand. But so let me go over crowding out one more time. Almost always, crowding out is going to be asked in conjunction with loanable funds. So like the first thing that you'd get is you'd get something that would say like draw a correctly labeled graph of loanable funds. All right. So part one, draw a correctly labeled graph of loanable funds. And then you're going to have your like shifter thrown in there, right? So draw a correctly labeled graph of loanable funds and show the effect of increased government debt on the real interest rate. So there you go. That's like what your question, like on an FRQ, that's what it would look like. A multiple choice question would be a little bit different. It might say like, you know, what is the effect of crowding out? Or it might be like, you know, it could be, I could give you a question where like I explain that the government is, that real interest rates are increasing because of higher levels of government debt. And then I could ask you like, what is the term that goes along with this? So it could be like a vocabulary question where then you'd have to choose like, you know, capital flow, crowding out, inflation, stagflation, and some other option down there. You have to pick crowd. So like multiple choice test, you could see it in kind of different ways. But for like in general, what is crowding out? This is the question right here that we have, right? Draw a correctly labeled graph of loanable funds and show the effect of increased government debt. So we're going to draw our graph of loanable funds. So again, lots of students, they put supply lenders, demand borrowers to help them keep track of who is who. We've got quantity down here on our x-axis, and then we have our equilibrium real interest rate. And if I wanted to show crowding out, you can do it two different ways. My way is that I think of crowding out as the government is going out there and the government is getting the people who would have been putting their money in the bank, instead move it into government bonds. And so what that is that's a reduction in the supply. Because remember that loanable funds, this is supposed to be the market for private loans. So the government really shouldn't be on this graph, but what's happening is it's kind of like a substitute back in unit 2, because this is really a unit 2 graph anyways. It's kind of like a substitute that like what's happening here is like rather than people putting their money in the bank, they're putting their money in government bonds. So the supply of loans decreases. And you get something like that. If you wanted, you could have increased the demand for loans instead. That's perfectly acceptable. Oftentimes for like kind of students who struggle a little bit, I encourage them to just think of it that way, that more borrowing by the government is more demand for loans. You increase the demand to the right, you would have had the same thing. You would have had real interest rates going up. So it goes up either way. And then the follow-up question that you need to be prepared for is like, what is the effect of crowding out on the economy or on aggregate demand, or what is the effect of crowding out on borrowing or on investment, or any of those kind of follow-up questions. It's all going to be based on the interest rate. So if the interest rate goes up, right, the economy is going to suffer, aggregate demand is going to go down, businesses are going to borrow less, consumers are going to borrow less. Those are all like the consequences that come from having a higher real interest rate. So, again, if you're looking for like what to prepare for this test on Thursday, tomorrow or Thursday, when you walk in the door, you have to know aggregate demand, aggregate supply, and fiscal and monetary policy. If you're taking a macro final and you don't know fiscal and monetary policy, you're screwed. I mean, that is what macroeconomics is all about. And in order to know monetary policy, you have to know the effect of interest rates. I know that interest rates are weird for you guys, that you're not at a place in your life where you borrow a lot of money or where you make personal investments, and that interest is kind of a foreign concept. But when you come in to take a test on macro, you got to know the effect of interest rates, that when interest rates go up, right? And I ask you, what happens? Interest rates are going up. You need to be able to say, interest rates are going up. Well, that means aggregate demand is going to go down because people don't want to borrow money to buy stuff as much, right? If I say interest rates are going down, what's the effect? You have to know. Interest rates are going down. Well, that's going to make consumers want to buy more. That's going to make producers want to, invest more. We're going to have more investment. It's just, you kind of got to know that. All right. Lenicia asked, are bonds government debt? Yes. So, yes, that bonds are government borrowing for sure. Are they government debt? Well, yeah, they are. That question kind of depends on what else is going on. So like the government might be running a surplus, but it might still be issuing some bonds and just stockpiling money elsewhere. But in general, yes, a government bond is going to be government debt. That's when they issue bonds, they are borrowing. So yes, a bond, government debt. Any other questions before I pull the plug on this? Alrighty, so I'm going to stop recording and I am going to